Welcome back. We are with David Burrows. We just got a tweet. Let's get right to that. Andrew says he's watching Market Call, looking forward to the show. He wants David's thoughts on Home Depot. Would you buy this on the dip? I covered this on the close last night, and basically analysts across the board are saying if you're seeing this pull back 5%, jump in.
Yeah.
But what do you think?
Listen, Home Depot has been an investment for us over many years.
Okay.
And the premise was that they were always growing their revenues well in excess of GDP growth, that they're great at executing, and that the dividend growth's been close to 25% a year over the last 5 years.
Wow.
Right? So it's not a big dividend, but it's good dividend growth. It's economically sensitive, attractive company. If I look at it, take it from the top, we are and have been favorable on the home builders and the suppliers into the home builders. As a sector, the ITB, ETF, or the XHB have been great performers so far over the course of the year. That's both the suppliers and the builders themselves. And of course, it's firmly in the suppliers group.
I want to see if our control room can pull up the chart, though, of Home Depot. Again, it is under a bit of pressure today, off by $3.70. Thanks, guys.
So what I was going to say to you is that it is a leading stock in a leading group.
Yeah.
And it has had some noise in the quarter, and there's no question. There are some question marks. They missed on the revenue side and guided a little lower. They tend to be cautious with their guidance. We've seen a lot of companies miss by a little, have the stock get hit for 2 or 3 days, and then come back. You know, an example was Caterpillar earlier. Started lower and finished up on the day. So I like the stock. I would give it some space because it's got the sector behind it. If you look at like a point and figure price chart on Home Depot, it's a healthy little pullback. So at this point, I would not be a seller of the stock, and I would buy the pullback.
All right, David, thank you for that. Let's switch over to Moody's now. Gail emailed us and wants your take on Moody's, wants to know if it's a good time to purchase this and hold it until uncertainty mellows. You think we've already mellowed, right? Yeah,
look, people have been in the ratings company and the index providers, you know, for predictability, and they've performed really well. But it's not just about that, right? It's about markets opening up for them that they haven't really been in, like China in particular, right? And this is a big opportunity for these companies because there's a ton of issuance coming out of Asia. So I like Moody's. It's the relative strength versus the market has been improving all year long. It's trading virtually at absolute new price highs. And I think it looks quite attractive. It's a 1% dividend that will grow pretty steadily. I don't think it has the kind of torque that you'll get from a JP Morgan or from one of the asset managers. But I think that you've got a tailwind in the sector, and it's a good grower.
All right, David, thank you. Let's get back to the phones now. Steve in Halliburton, Ontario. Hi, Steve. Steve, are you there? All right. Pembina?
Pembina.
Yeah.
So Pembina has been a pretty good performer, really there specifically for the yields, a 5% yield. If we are going through reacceleration, unless we see more pickup in the energy space, it's probably going to be a neutral performer. But it's a great yield play. And for an income investor, I think you're probably in a good spot.
Okay, David, thank you. Let's see if we can get John on the line from Hamilton, Ontario. Hey, John.
Yes, good afternoon.
Good afternoon.
I have a question concerning AltaGas.
Right.
I wonder, it seems that they have an excellent portfolio of investments. Recently opened up Ridley Island propane exporting. I think over half their business is in the United States, and it's regulated. And it seems it gets no respect. It seems it's sort of being, I guess, tarred with the same brush as the oil and gas business. But I think this company is a utility. So I'd appreciate your comments.
Yeah.
The Rodney Dangerfield impact.
Yeah, you know, here's the thing. You've had an incredible bull run in defensive assets.
Right.
So as somebody said to me one time, if something can't fly in a hurricane, turkey can't fly in a hurricane. There's a reason. Look, I think that the outlook forward for utilities is a little bit muddied not because they're not great businesses, but because they may not have the attributes that investors are going to look for if they believe the economy is reaccelerating. And so given the fact that you've had this great run in defensives and AltaGas did not participate, if you think that the defensives could underperform going forward, think of it this way. Utilities have a correlation to a rising market of about 20%. Industrials about 90%. So if we believe the market's going to be decent over the next 12 months, and people are heavily weighted already in defensives, they can become a source of cash to move into things that are more tightly tied to the economic cycle. So I don't think I would be a buyer here.
Okay, let's see if you like this next stock. We haven't gotten a call on this in quite some time, but let's head to Edmonton, Alberta, where Repo is standing by. Good day. Hi, Repo, are you there?
I am Ethan David.
Hello.
Yes. I have a question about the stock, what it is. Vodafone, VOD. I've been with them for a while and they haven't done too well. What do you think of it, please?
Yeah. I'm going to put Vodafone in the same camp as AltaGas.
Right.
You know, again, you've had the perfect environment for defensive assets. Yes, it's a 5% yield or 4.8% yield, but there's no earnings growth. It's only 8 times earnings, but it really doesn't have that thing that we're going to look for if we believe that the world becomes more optimistic. And so, again, I would stay clear and find something else that has a yield to it, but more specifically, a growing dividend, more quickly growing dividend that would do well, for instance, if long rates start to tick their way higher. Just going back quickly to the inverted yield curve.
Yes.
I just want to point out in the inverted yield curve, we had from the 2-year to the 10-year bond, the differential inverted for 6 days.
Right.
And it was the shortest and most shallow inversion in history.
But it spooked everybody. Everybody became a bond market expert.
The yield curve today is completely normal. So I think that way too much breath has been spent on the inverted yield curve.
But they're saying the fact that it happened from the point that it happened to 18, 22 months out, that's when you got to be worried.
Yeah, but if you look at history, it
Yeah.
depends on the length of time it's inverted.
Right.
And the depth of the degree to which it's inverted. It inverted by a few basis points for 6 days, and very quickly became normal again. So I would not be concerned about that.
That whole week, all I know is every market call guest is calling.
Oh, I know, our phone was ringing too.
Wanting to know about bonds. What are bonds? How do I buy these things? And is the world ending?
So I can't tell you how many meetings I went to in August where people said, all I'm doing is buying long-term bonds. Right. I said, but the yield is like 1.55, 1.55 for the next 10 years. That'll probably be what inflation is. No return. Doesn't matter, I'm going to make capital gains. Well, how are you going to do that? Well, rates are going to go lower. I said, well, what if rates go higher?
Yeah.
We're basically effectively at a generational low in yields.
You got it. So. Yeah, and that's what we keep forgetting, right? We're really into the minutia of where the rates are right now, 25 bips either way. But when you look at this historically, if you go back, if you purchase real estate, our parents did 20, 30 years ago, they were paying upwards of 18 to 22%, right. As far as interest rates were concerned. We're nowhere near that. And again, I don't want to go off into a rabbit hole here, but a lot of folks say, enjoy this while you can. This is not going to last forever. If you do have a home, if you're thinking about refinancing, you might want to investigate 10 years. Yeah.
Rates bottomed the last time in 1951 at 1.6%, the Treasury bond. And then they rallied from 1951 to 1981, 30 years. And then we've had 35 years of falling rates. And we made a low in 2016, and bond yields did pull back again this summer, but to a higher low. Which I think is important, and have made an important turn. So I don't think it's going to happen in a hurry. It took 15 years to go from 1.6 to 6% in the 50s and early 60s. Likely to have something similar to that. But we need not to focus on the things that did well in the 35 years of falling rates. We need to think about what does well if rates slowly were to creep higher. Right. What type of assets do well in that environment?
That's the new
different
narrative.
Assets.
That's the new narrative. All right, David, thank you for bringing that to us here on Market Call. Stay tuned. David's past picks are coming right up, and they look very, very good. You'll be impressed.